Welcome to the Money Insights Podcast, where high-income earners come to learn wealth-building strategies that will take them from high income to high net worth. With your hosts, financial and wealth-building experts, Christian Allen and Rod Zabriskie.
Welcome into today's episode of the Money Insights Podcast, the alternative wealth-building podcast for high-income earners. My name's Christian Allen. With me, as always, my beloved co-host, Rod the Pod Zabriskie. Rod, what's up?
Hey, I'm doing great. I like beloved.
Yeah, beloved, Rod. Is it beloved or beloved?
Well, okay, so I'll tell you where I get that. There's a book that my wife loves to read to the kids. It's called Just So Stories by Rudyard Kipling. Old, like Rudyard was like, I can't remember, like 1800s, something like that.
Okay.
But they're pretty fun. They're pretty fun. And just whenever he says that word a lot in the stories, because it's like he's telling them to his grandkids or something, and so then when she's reading it, then it's all, best beloved.
That's where it comes.
That's how she says it. So that's
all right. So you say beloved, could be beloved. I think you can go either direction, but it's an interesting conversation. Okay, Rod. Today, we're going to do something new. We're going to try something a little bit different.
Yeah.
We've never done this before. So here's how this is going to go for the audience. I asked Rod to pick out headlines, just like kind of headline, and it doesn't necessarily have to be like totally recent, but just headlines, financial headlines that we think are relevant and interesting to talk about. But here's what we're going to do, Rod. We're going to put them up against the invest with benefits smell test.
Okay.
Yep. So as we go through the financial headline, whatever direction we're taking it, then we can kind of grade it against our philosophy of investing with benefits and see how it stacks up. Does that work?
That's perfect.
Okay. So I, like I said before this, like I found this to be a little bit more difficult than I originally anticipated. Because you want to have like a mixture. I wanted to have some that are like fun, some of them that are more serious, like and I found that most of them were just boring.
Okay.
Like most financial headlines are just really boring. Like that's just kind of the way. But Rod, I do feel like I found a handful of them that meet the criteria of what we were looking for. So I'm excited about that. How did you feel about it as you were going through things?
I felt very similar because unless you were interested in specific stocks or specific companies or specific, like what happened yesterday in the S&P 500 or something.
Yeah, there's a lot of that.
The majority of the headlines out there are. So I had to drill down a little more to really find things I felt were fitting to what we're looking for.
Relevant. Okay. And here's the thing, like those kind of things could be interesting if it was like stock market creates millions of overnight millionaires. Now that could be interesting.
That would be,
right.
Yep.
Okay, but that's probably not happening, or at least not responsibly. Okay, Rod, I have like 10 or 12 that I can get to, so I'm just going to kind of pick them as we go. I don't plan to get to all of these, but I'm just going to decide in the moment what I feel like makes the most sense, and it's going to be a wild ride, but we'll see what happens.
Okay, that sounds good.
Okay,
you told me to grab a handful, so I don't have quite that many, but
that's okay. That's okay. Do you want to go first, or do you want me to?
I can, sure.
Okay, roll, Rod.
Okay,
Number one, your first one.
This is the best one I found. It's the headline is "How to Save $1 Million by the Time You Are 50."
Okay, exactly $1 million by the time that you're 50.
Yeah, it seems that a million is still a popular number to use out there, because I actually have a second headline that focus was around $1 million again. It's a round number. It used to be a lot bigger than it is now, right? Especially inflation erodes that. But
basically what you're saying, Rod, is that for some odd reason, that $1 million number just still remains this like major benchmark, even though the value of it is significantly less than it was 20 years ago when it was a bigger deal. Right? Or 50 years ago. So
100.
It is interesting
to be a millionaire 100 years ago. It was a big deal, and
now that was really something.
And it's still. I'm not saying it's like nothing, right? It's not a
right. No,
little
it's
deal,
not nothing.
But But yeah,
Well, and
100 years later, 50 years
it's
later.
all relative, right? If
Yep.
you're most of the people that are like the typical client, the typical person that's listening, that's a high income earner, probably is shooting higher than that $1 million. Now,
Mhm.
at least they went 50, Rod. It wasn't like how to save $1 million by the time you're 72.
Yeah.
Because that's like, whew, at least by the time you're 50, you still have some time to get to like, 2 or 3 million, which
Yeah.
still, by the way, may not be enough,
Right.
but at least you have a little bit more time. So that's an interesting thought. So anyway, that's what comes to my mind as I'm hearing that headline.
Yeah. Now I was a little bit disappointed because what I was expecting to find when I got into it is some sort of baseline assumptions of, if you're 20 or 25 or something, and this is your goal is to get to $1 million by 50, then you're going to have to save this much. You're going to have to
Earn or
earn
save. Yeah.
such and such, kind of return and roll that over and have tax benefit or whatever. But unfortunately, there was actually none of that.
Okay.
What
What
it
was
turned out
there?
to be is just some really unhelpful or less helpful. I should say unhelpful.
Was it
less
like,
helpful.
take advantage of your employee benefits, or was it like
It
make
was
sure that you use an HSA?
It was stuff like that. Okay, so the first pointer is use a high yield savings account.
Oh, it's even worse. I was going to say, or is it like save by using this credit card at a 0% APR?
Yeah,
Like
it's not even
it's
that. Yeah, it's not even that.
whew,
So,
okay.
so start with a high yield savings account. And I mean, again, it's not like it's not helpful at all, because if you have a bunch of money sitting in your savings account at your local bank, and
Right.
instead you could be
That
going
is
and
a step
getting a
that's
better
better
return somewhere else,
for sure.
then
Right.
do it.
Yeah,
Yeah.
that's better.
So, helpful advice, but I'm not sure
Was
the
was there
savings.
any other helpful advice?
Yeah, I'll hit on a few of these others because
Okay.
so then the next one is save with the tax advantaged retirement account.
Boo.
It,
Just kidding.
well,
Just kidding.
it
That's
again,
that's only a partial boo. It's more like a meh.
yeah, and that's fair because guess what? If you're saying, hey, if I can get to $1 million, I can retire. Well, I'm sorry to say, if you get to that million at the age of 50 and you did it in your 401k, you got to wait another 9 years, 9.5 years before you're going to be able to really start making use of that money. So,
Rod, you could just suck it up, take the 10% penalty, and roll along, or take advantage of that incredibly valuable 72T rule that allows you to take like a very
couple
small
percent.
percentage of your account
Yeah.
value out, which wouldn't equate to enough to actually like replace an income. So
Yeah.
you're right, Rod. That is problematic at
So,
50.
okay, that's that.
Okay.
The second or the third one is make smart investments. So
Brilliant. I
again,
agree.
I was thinking, man, okay, now we're really getting to something because they're going to tell us, what kind of return. But again, it doesn't get to that level. Basically, what it's saying is whether you're doing it in a tax advantage retirement account or in a separate brokerage account, it's all about investing in the stock market. Do it early.
I don't have any words other than okay, I guess.
Yeah.
Sort of.
Yeah. And again, it's probably the stuff that you would expect to hear as it relates to this in the media, because it's all about, get started early so you can take higher risks, because as you get closer to retirement, then you have to switch and have less risky portfolio.
Okay, Rod,
But
this is boring. We need to grade this article, this headline on the invest with benefits grading scale,
okay,
which
can I give you one last thing? Because it's gonna
okay, yes,
it
okay.
the last
Sorry.
one that
I
you
was
have
premature.
here is use certificates of deposit.
Oh, finally we get to like real valuable advice.
Yeah,
The
because that's
stuff that
gonna get you to $1
but can
million.
I just tell you, those articles, Rod, are everywhere. So like if you type in Google, uh, what's the best way to get wealthy, you'll get numerous articles that are like that. Now, I will
Mhm.
say this though, Rod. I look at these and I think about like our typical client, our typical listener, and I'm like, that there's no way that our people are paying any attention to that. There's just no way. They're way more savvy way more sophisticated than to be dealing in that.
Okay, you would hope so. But
Are you saying they're not?
this link was sent to me by a client
Oh,
just
yikes.
in time for this. And so now the
Holy
nature
smokes.
of,
I genuinely didn't know that, Rod. This wasn't like a setup.
no, the nature of our conversation
holy
though was
smokes.
this. Because he's all on board on the alternative investments. Basically,
Yeah.
what we were doing is we were saying, can it be done? Like, can someone using the traditional planning stuff out there, using the stock market, do this, right? Like get to a decent retirement, get to the million by 50 or whatever. And unfortunately, he was using this as evidence that, oh, hey, it turns out that you can get to a million by 50. And so, which was probably part of the reason why I was expecting there to be a little more hard evidence of, hey, if you do this, you get this return, you compound it, whatever, then voila, age 50, you're there.
Okay. Man. Okay, so are we ready to grade it yet?
Yeah, let's do it.
Okay, so are we grading on a typical A, B, C, D, E?
Yeah.
Not E, no E's.
No E's.
F's?
Yes. Yeah.
Okay, I will give it like a D plus.
I think it's generous.
Probably generous.
Yeah,
Generous.
I think it
I
is
was trying
generous.
to. I mean, it did have like you said, better than nothing. Using a high interest savings account and potentially a tax deferred retirement account. So it wasn't like absolute zero, but it was certainly not anything to get excited about.
Yeah,
So anyway, that
so-
might have been generous, but that's where I went. That's
Yeah,
what
I'll
I'm
just
going
go with the D. But the challenge with this is, I often use the word that this is like the loudest voice out there is telling you to do these things, and we're telling you alternative investments, invest with benefits, is a much better way to go. And like you said, this is just all over the place. Like who
It is.
If you've read 10 articles like this, you didn't need to read this one because it's just telling you the same thing as you read in everything else, right?
Okay. Don't listen to that garbage. So I again, I can't imagine that like people, it almost feels like fake, right? It feels like most of it's like clickbait. It's just like the same stuff, right? And usually it's promoting, like I say, credit card opportunities or banks that want to put, want you to take your savings there. Like, but it's just like not real advice whatsoever. So I would hope, Rod, and I'm a little nervous now that you said that. I kind of wish that you would have kept that news to yourself, but I'm still hoping, praying that like 98% of the people we work with would just think that was like not even worth a read.
Yeah.
Okay. Whew. Okay, Rod. We gotta move along here. We're gonna take all day if we take that much time on it.
Yeah.
Okay. Good news is I think I've got something a little more exciting.
Okay, I'm ready.
And in the spirit of the true spirit of Halloween, which we're just 2 days away from, I'm looking out my window and I can see like Jack Skellington up there. I've got a giant pumpkin, a giant ghost. Like we were rocking out for Halloween. My kids love it. And they would be really disappointed if I didn't focus on Halloween for this particular endeavor. So here's the deal. This is great, Rod. This is the headline. Pumpkins shaped like people's heads. A dream come true. Okay. And now I've got to read just a little bit for.
All right.
So I'm gonna teach you a little bit, everybody, a little bit about Pumpkinstein. Now you may have already if you're listening to this, maybe you've already jumped on the craze, but if you haven't, Pumpkinstein is becoming a thing. Okay. Tony DeGuerra was working long hours, losing sleep, running low on money, but the organic farmer from California had a great pumpkin dream. The dream was to grow pumpkins into shapes using molds and become rich, harvesting the frankenfruit and selling it for top dollar. He said, I couldn't make it work. I tried everything and it would not work, to the point where I was just ready to give up. Okay, I'm not going to read the rest of the article, but here's what I'm going to tell you. He kept with it. So last year he sold 5,000 Pumpkinstein pumpkins for like, I think they sold for like $100 or something like that.
Okay.
Right. But he just was like, I don't know what to do to like really take this thing to the next level. Well, guess what? He found a partner. And really, I should say this, a partner found him. And he, this year, working with Sam's Club, has put out over 90,000. So they went from 5,000
Yeah.
at like
Wow.
$100 a pumpkin
Yeah.
to 90,000 in a year. And this man's dream of becoming wealthy, harvesting, what did he call Frankenfruit,
Mm-hmm.
creating pumpkinsteins, was absolutely it absolutely came true when he made that relationship with Sam's Club. He became instantly wealthy, and now he's rolling, man.
Wow.
So what do you think of that, Rod?
I did not see that coming, because even when you were saying in the shape of a human head, I was just thinking like, okay, generally having kind of the dimensions, but this is like legitimately
Yeah, I think so.
molded
I think
to that shape,
Yeah, I think it
but
is.
real fruit,
These
real
pumpkinsteins are
pumpkin.
legit. I
Yeah.
wish that I would have like thought ahead enough to give you uh a like picture to put up on the screen for us. But anyway, look it up. Pumpkinsteins are a real thing. And I got to be honest with you. I have every intention of ordering a pumpkinstein next year. So we're 2 days past. Like, probably doesn't make sense this year, but next year I've got. And I love, Rod. I love the story that this dude followed his dream as an entrepreneur, and he created something like really amazing. It's just
That's
like a really
awesome.
great story. So
That's
anyway,
awesome.
this one for me was an easy one to grade. I'm giving it a solid A on the invest
Yeah,
with benefits scale
absolutely.
because, Rod, think about it. Think about like he's using things like leverage, right?
Mhm.
He used the leveraging the relationship with Sam's Club to like really take that thing big. And
Yeah.
of course, all of the benefits that you get with by being an entrepreneur. I just think it nails it on the invest with benefit scale. So
Will
I'm
you
giving
do
it
a
an A.
favor for me?
I will.
When you get your pumpkinstein, will you also find a melon hat appropriate for it?
Yes. I actually was gonna order a bunch of melon hats so that I could put logos on them.
Okay.
And I think I can find something that makes sense for Pumpkinstein.
I love it. Okay.
Okay.
Look forward to seeing
Okay.
that.
Well, that was my first one, Rod. This is going better than I thought. I'm
Yeah.
excited, man.
Well, you
Good
definitely
story.
dug a little deeper than I did. So you get to go. And again, because I only came with a couple. So
Oh, do you want me to go again?
Yep.
Okay. Okay, Rod. My second one, we're taking this in a little bit of a different direction, but
Okay.
this is a big headline today. It's a big headline, and it's certainly relevant to the things that we talk about. So the title or the headline kind of tells the story, but I really like how this was. New York Times. Home sellers win 1.8 billion after jury finds conspiracy among realtors.
Wow.
You heard about that
Yikes.
story yet, Rod?
I did not hear about that one. So it's like a class
Okay.
action.
Yeah, I guess so. Basically, there's like, yeah, at a very large level, there's a lawsuit that's against like the major real estate companies, like
Mhm.
basically all of them, right?
Mhm.
Like Keller Williams. Anyway, you go on and on. But the idea is basically they're saying that realtor commissions are significantly higher in the US than in other um like first world
Developed
countries.
companies. Yeah. Companies.
Developed countries. That's the word
Mhm.
I was looking for. And anyway, like they said it was like 3 times higher.
Oh,
And I can tell you that people are not happy about that.
no.
And they're feeling like it's making it difficult. Now, there's two sides to this story though, Rod, and this is what I think is interesting about it. The other side of it is that the realtors associations, the people representing the realtors are saying like, hey, doing this, like reducing commissions, doing these things is going to actually make it more difficult to get quality advice, quality help and support so that
Mhm.
they can actually buy and sell homes reasonably well.
Yeah.
So it's really an interesting back and forth, but at least as of right now, the jury has awarded 1.8 billion. and they think it's going to go up. The attorney had a quote that said something about they expected to get to 5 billion. Now,
Yeah.
their job is to continue to move it that direction. So I'm not
Yeah.
right now. It's 1.8. That's a lot of money. That's
It
all I'm
is.
saying. Kind of wild.
And who gets that? Is it everybody who bought a home, bought or sold?
It's a great question. I
How,
probably should have
how
read
do you get in
further to
on that
figure
one?
that out. I don't know. That's a good question. I bought a house.
Yeah, you did.
Although, can I just tell you, I was happy to pay my realtor
Yeah.
the commission that he made. So Scott, if you're listening to this, if they try to make you give that money back, I don't want you to. I'll just give it back to you again.
Yeah. Yep.
So,
Same here, Scott.
So, okay. Yep. Same guy.
Yeah.
Okay. Well, Rod, I don't know how to grade this one because it's kind of it doesn't necessarily fit in that same like grading scale, but is there a way to grade it, Rod?
Well, okay, let's do this. Let's look at it from the side of the homeowners that did the suing, and we'll say it's like a maybe a D, because don't try to build wealth through going out and litigating. How's that?
Okay, I like it. So the litigation methodology as a wealth building tool is probably even an F.
Yeah.
Now, so I'm going to give that particular strategy an F. Although, Rod, I always say this, the situation is absolutely the boss.
Mhm.
And so if there's like a definitive situation that's
Sure.
unique to you, then it could be a significant thing. But for most people, litigation's not the answer.
Yeah.
So
Well, and
that's
the
bad.
other thing, so maybe let's do it from the other side too. You were happy. We were both happy with Scott because he was great. Like, he did his job. He was there. He helped us and earned what we paid him.
We were happy to
right?
pay him for it.
And I've seen a bunch that do that. And I've seen situations where they did not earn their keep, but they still get paid. Like, that's just the percentage. They're just going to get what they're going to get. And regardless of how helpful they are. So maybe, do a good job for people. Right.
Okay. Here's a question, Rod. From your perspective, is this good for home buyers, for consumers, home buyers?
Okay, there are a lot of industries out there that have just like this tradition, right? The percentage of what you pay a realtor is tradition, right? So is it probably fair to say that, especially in a lot of markets in the US, that market values are higher here than they are in other developed countries? That's probably true, right? So then when you take the percentage of that and you say, well, in dollars and cents, how much did they get paid? Well, they got paid more here than they are getting paid elsewhere, but it's based on that percentage, right? So if something like this can shake things up a little bit, make people rethink and not just go with it just because that's what tradition was, then I think it could bring some benefit. But if it's just,
so it can create some balance, and yet again, probably not a good win, not a good day for realtors.
Yeah, not a good look for sure.
Okay, Rod, why don't you give me your second one?
Okay, so this one, I was surprised when I found this, and we can be fast on this one, but basically the headline is 401k retirement plans are growing in popularity. And my first thought, my first thought was, how can that be possible? Like, I don't know how you exactly measure popularity, but if it's like everybody's doing it, everybody's talking about it, that's how people retire in this country, or how that, at least how that conversation goes for the vast majority. I don't know how it grows in popularity, but that was a surprise. And in fact, the first line in the article says the 401k is rapidly becoming the most popular qualified retirement plan.
Wasn't it already?
That's the thing. But it's dated November 3rd, 2023, which, as we speak, it's actually not even November 3rd yet. So there you have it.
Okay, well, that's interesting. I'll give you that. I think, Rod, that I hate to give it an F on the invest with benefits scale, because you are investing, and that's something inside of like a qualified plan, right?
Yeah.
Theoretically, you're putting it into mutual funds or whatever. That's positive in some ways. You're tax deferring your money, which may or may not end up being helpful and valuable, but
Yeah.
you're also locking it up and, keeping, there's lost opportunity costs to
Mhm.
having to keep that money in that one place. But you also may be taking advantage of a match in order to get that. And that's money that you wouldn't get otherwise. So I feel like I should probably give, well, the fact that it's like that it's rapidly growing. Is that true? That
It's
doesn't make any sense.
no, it doesn't.
Okay, well, I give the headline uh F. I give the idea behind investing in qualified plans like a C.
Okay. Well, what I'll do is I'll turn your C into a C plus only because they because Roth 401ks have become more of a thing.
Oh
So
yeah, that's
so you
true.
were saying,
That's true.
deferring your money is good if that's good. Well, if it's not and you would rather just pay the tax now and then not pay it later, then and inside of a Roth 401k, you can contribute more than you could in a Roth IRA, number one. And number two, it doesn't have income limits. So if you want to do a Roth IRA, but you make too much, you can't do that. But it doesn't matter how much you make. If you're offered a Roth 401k option, then you can opt in regardless of how much you make.
Okay.
So
Those are all really good points. I wasn't thinking about that on the other side. So um I feel like you may have like nudged me up a little bit. So that was pretty it's not bad, right? Like it's not bad.
C plus, that's pretty good so far.
Certainly, I mean, it's a little bit better than average,
Yeah,
right? So
yeah.
we'll take it. Okay, Rod, my next one, I'm excited about this. I'm really excited because I
Okay.
think this is good. This is good. So it's coming from, I should have been saying the websites that I was looking at. This one's on the NASDAQ, NASDAQ.com. Okay. 3 reasons whiskey is the money-making alternative investment of the ultra wealthy you may not have considered. You may not have
All
considered.
right.
Okay. 3 reasons whiskey is the money-making alternative investment of the ultra wealthy. Okay. Let's see if we agree with the 3 reasons. Okay. So, number 1, Rod, commodities do well during inflation. Okay. Number 2, whiskey can preserve generational wealth. I love that one. And number 3, people like to drink whiskey. Okay, so number 1, Rod, what do you think? Do commodities do well during inflation? Is that a reasonable claim?
They do well in the sense that it's a hard asset. They hold their value, right?
Yeah.
So even if you only measured it by inflation and it held its value, then you're whatever inflation was, that's what you earned, right?
Yeah. Here's what they say. As costs for these commodities go up, as they do in an inflationary environment, the value of whiskey rises.
Yep.
In the last couple of years, the barrel market has seen rather consistent, stable appreciation, as is expected for the long term for an industrial asset. Interesting.
Right.
Okay. So I think that one's probably a fair statement. The second one, whiskey can preserve generational wealth. I feel like I need to state what they say just so we have a reference for what we're talking about here. Okay. There's barrels of Scotch whiskey on the planet right now that have outlived their original owners. Typically, bottles of whiskey aged 50 plus years may sell for hundreds of thousands of dollars. I didn't know that, Rod. That means the barrels themselves are worth many millions of dollars, she said. People can do and use this as a succession plan. People may purchase a barrel when a child is born and then pass the barrel on to the child to pay for college or a first home when they get married. In the latter case, the investor may also bottle some of the whiskey for wedding favors as a gift to the bride and groom. Look, there's just all sorts of things you can do. But the point is this is a way to preserve generational wealth. So whiskey, generational wealth combined. I like it.
Yeah.
What
So
do you think?
you're taking them to school, you deliver them with all of their books and well, I mean not books anymore. People don't read books anymore, huh? Anyway, you deliver them with all their stuff and then you roll the barrel up and you say, "Here you go."
Here you go. Yep. Take it with you. Well, can I just tell you, man, this is like, I didn't know that a barrel of whiskey was like the do it all investment,
Yeah.
but apparently it is.
Yeah.
Apparently it is. It can take you to college. You can get your first home. I don't know if you just sell like a portion of it, or if you have to sell all of it at
Yeah,
one
like
time.
you just start
And
pulling out and filling up bottles and selling it a bottle at a
maybe,
time.
yeah, I don't know. Maybe you get it. Maybe it's one of those things where you get the barrel. Maybe you get up to like college age, you sell the barrel for whatever that value is.
Yeah.
Then, Rod, you place that money into the investment optimizer to pay for, then you pay for college through the policy, and you start to invest in other places to continue and perpetuate the generational value of that barrel of whiskey.
Brilliant.
Okay.
Okay. I can
Okay.
buy
And
that.
then number 3, and I don't know a lot about this, Rod, but people like to drink whiskey.
Okay, so this one is the part where it deviates a little bit from the original idea. Now, if you're saying people like to drink whiskey, therefore they're willing to pay a lot for it, and if you're the seller and you're getting a lot for it, then that's good. And I also hear about people who will break into their very expensive liquor and drink it on special occasions, and then I mean,
So
if
you're
it's
saying don't drink your investment
if
if your barrel is for
if
that, then you better
yeah,
not consume it.
if your purpose was to drink it, great, go for it. But if your purpose is to create generational wealth or do some of these other things, then maybe not so much.
Okay, so Costa Van Putten, he was the expert that they were interviewing in this, says half the people that come to us are big time whiskey guys and gals. The other half, however, are just looking for a solid investment with attractive returns, unrelated to the stock market or other financial markets.
Okay, yeah. So if you're the seller and there's a big market because people want to consume the expensive
They're
whiskey,
saying
then yeah,
take advantage of it.
yeah.
Okay, so Rod, I'm going to give this a solid B+ on the invest with benefits scale. I think while you probably don't want to go all in on whiskey,
Mm-hmm.
there is value in assets like this kind of thing that you don't typically think of.
Yeah.
Right? We think of it like fine art. I've got an artwork
Oh,
one.
okay.
That's a
All
little
right.
bit of a
Teaser.
teaser.
All right.
Yep. So anyway, like in terms of in the invest with benefits philosophy, I think it for the most part like encompasses that.
Yeah.
It's just a matter of like how big do you want to go in like one specific asset class, and especially one that's like ultra niche like
Mm-hmm.
whiskey.
Mm-hmm.
But having something like this as a small portion of your portfolio, man, I think it could be good.
Yeah.
So yep, I give it a B+.
Okay, well, I'll go with a B. And my thought is we often talk about in the alternative investment world, it can include all kinds of different things. Well, why shouldn't it include this, especially for somebody who we also talk about invest in things right? If you have some sort of knowledge around this, or people that you trust and you can collaborate with them on it, then why not? I like it.
Okay, well said, Rod. Okay, I'm going to go again because I have more than you.
That's great. Yep.
So here's an interesting one, Rod. Are alternative investments becoming mainstream?
Ooh.
Okay.
All right.
So and really that's the question. So, but that's the headline. And
Mhm.
I want to get your initial reaction just based on the headline, nothing else is actually in the article. So the question, Rod, is are alternatives from your perspective becoming more mainstream?
Well, I think the same reason I felt like that the headline I gave where 401ks are growing in popularity is the same reason why I feel like what you're saying is true, that alternatives are becoming more familiar to people, more people are aware of them. They're looking for alternatives. And again, I'm a little bit jaded because I'm so regularly meeting with people who are coming that direction toward alternatives. They've decided
So you're like 90% of people love alternatives.
Yeah, they love them.
Just are all
Everybody
in on it.
does. Nobody wants a 401k.
It's weird.
Everybody wants alternatives.
That's Rod. Come on, don't bash 401ks. We just gave it like a C. So that was.
I know.
Couldn't you have said like I don't know, what's a really bad vehicle that we really don't like?
Well,
I mean,
mutual
like CD,
funds.
like mutual fund. No, it's not even that, because mutual funds are part of the 401k. Like
I know.
again,
Okay.
that's
All
getting a
right.
C on the scale. you're being way over biased, but luckily I'm here to like
Good job.
create a little balance in this
Yeah,
situation.
man, everyone's grateful.
Okay. Okay. So I think it's a valid question. And here's what I'll say. I did read the article, and basically what they suggested is that our alternatives are moving up. Like, I can't remember the percentages, but based on last year at this time, based from last year at this time to today, it's up like 7%, something like that, which is pretty. And when I say 7%, I'm saying 7 percentage points. So that would be like up, 20, 30% from a year ago,
Yeah.
right? 25%. So here's a couple thoughts on this, Rod. One, millennials and Gen Z lead the charge in demand for alternative assets. So compared to older generations, younger investors allocate a higher percentage of their portfolios to alternative investments. In our survey, 72% of millennials and 85% of Gen Z surveys said they dedicated between 10 and 20% of their portfolios to alternatives in 2022. Interesting.
Yeah.
So is it fair to say, Rod, that the younger generations just tend to challenge the status quo? Right.
I would say that's true. Yeah.
And like us older people should like really try. I mean, like middle-aged people, but as we get older, we should really try to like consider, like, instead of being like the crotchety old guy, I have this goal of being like, I was going to say, I'm not trying to be hip. I'm not trying to be cool. Let's be real clear about that. But I do want to understand like what's actually going on in the world and realize that things just always get better, right? Generally, challenging the status quo often leads to better results. I would suggest that this is a good sign. Millennials and Gen Z, they're thinkers. They usually want to work less, gain more. Isn't that the joke? These millennials, they still live in their parents' basements. I'm a millennial, by the way, Rod.
Yeah.
Did you know that?
Yeah. And you're not in your mom's basement.
And I am not in my mom's basement. I haven't been for a long time either, Rod. But I was once.
That's great.
Okay. A couple other thoughts. What does the demand for alternative assets mean for financial advisors, Rod?
Mm-hmm.
That's the question I want to ask you. And then we're going to move on to the next headline. So what do you think?
Yeah, well, this is the one that it's really tough for a financial advisor to get on board with these unless they're going to become a real estate professional, a real estate agent, right? Start cashing in on the actual sell or the buy of the assets. Because as a traditional financial advisor, you can give out the advice and then they're going to go and buy it and someone else is going to get the commission. Right.
Yeah, there's limitations on what you can like you're likely not going to say, hey, real estate's amazing. If you're a traditional financial advisor, you're probably not going to say real estate's an amazing asset. I would go connect with some agents and start looking for some, beat up houses to renovate. They're probably not going to do that. They're probably going to say real estate is a great alternative asset class. Let's look at a real estate investment trust as that's doing XYZ as an alternative, but still acts and feels like a mutual fund.
Yeah.
But is basically has an alternative underlying asset. So but it's not the same, right? There's
the same is going to be
big difference between how those two investment styles actually work.
Yeah, you're absolutely right. And the same is going to be true with precious metals. Well, don't go buy the gold, buy a stock, in the gold company or these funds or whatever. Whiskey. Are there whiskey
I don't know if there's whiskey stocks.
There?
I don't know if there's whiskey. Maybe. It's it's a big industry, Rod. I wouldn't be shocked.
Yeah.
There's got to be whiskey companies that you can buy stock in.
Someone's out there.
So anyway, okay. I would say this, Rod. It's probably not great for traditional financial advisors. I would say it's good for people who are willing to adjust, who are willing to zig and zag when the time is necessary.
Open-minded.
But if you're like set in your ways, man, this is going to be, I believe it is going to continue to be more difficult for traditional financial advisors. Just my take.
Agreed.
Okay, Rod. On the invest with benefits scale, I don't know what to say. It's some of these don't fit my invest with benefits scale very well.
I'll just say it's AA minus because it's right there with what we're doing.
You're right. It's saying that alternatives are starting to like take hold. So that's an A headline. I'll take it. That's because again, we believe that is one of, if not the primary driver for wealth creation, like the most effective type of wealth creation.
Mm-hmm.
So from that standpoint, I like it. I'm giving it a full A, Rod.
Sweet.
A Rod. Should I start calling you A Rod? Oh, that doesn't fit. Never mind.
Yeah.
That was A Rod.
Okay.
Just clarify.
No hyphens.
Okay, Rod. Next one. Why don't you tell us what you got?
So I've got one more. The headline is "Land is underrated as a source of wealth."
Ooh, land is underrated. Maybe land is underrated as a source of wealth.
Yeah.
Why?
Okay, so it was an opinion column, but it was actually published by Bloomberg, right? I mean, who would have guessed it? But hey, there you have it.
Crazy.
And what was interesting is what they're doing is comparing it against equities. So they're saying if you look at the stock market from 1870 or something to today, and you compare that against the growth in value of land, then they're actually really similar, almost exactly the same. Now, what I would then say and add to that, because actually in the actual article, they're going back and forth a little bit. Should I invest in stocks or should I invest in land? You're going to win either way is basically what they're saying. However, the thing that they conveniently or not conveniently left out is they were only looking at the value of the land. It's like buying and holding and keeping the land, but what are you doing with it, right? If it's an income producing property, now that takes it to a completely different level, because not only did you roughly match the growth of equities over between 1870 and today, you had income along the way. And my guess is a lot of it that pushed it from, what they're saying was on average roughly a 8 to 10% average appreciation of value over those years to whatever 20-25% when you add the income.
I don't know what to say, Rod. I'm not sure what to say.
So it just in terms of like the grade, the headline is good, right? Underrated. We can all agree on that. Once you get in the meat of it, it kind of waters the message down a little bit. So as an article with the investment benefits scale, I'm going to give it like a C.
Okay, Rod, will you tell me the headline one more time? Land
is underrated as a source of wealth.
Okay, it's interesting. I do like I've seen some people do really well with land. In fact, I had a friend years ago. I have a friend, but I haven't talked to him in a few years, but he did some crazy deals in the land market right in the 2008. And really he was an agent, but really an investor, just happened to be, have a license. But he, in a very unique market, was able to grab land, basically like sell it immediately without even taking possession of it for, significantly more than what he bought it for. And he was able to do that a few times, really did well. But that doesn't really, I don't know if that really fits the gist of what we're talking about here. So can land be a good investment opportunity? I think in the right situation, it could be. But I think a C is a solid grade for it.
Sweet.
Okay, Rod, I've got some more, but I'm not gonna take us to 2 hours of this, but I am gonna do a couple more just for fun.
Okay. Yep. Sounds good.
I want to give us the other side, since I talked about how alternative investments are becoming mainstream. My next one, Rod, is the 5 downsides of investing in alternatives.
Okay.
What do you think? Okay. And I want to know from your perspective, are these genuinely downsides? And would they be enough to stay away? Let's figure it out. Okay. So the first downside, longer time horizons. What do you think? Is that true? Is that false? Is that somewhere in between?
Well, It's all compared to what, right? But if you are
Yep.
comparing it to what most people are saying in terms of 401k, then the 5, 7, 10-year time horizon is going to be much better for me than when I was putting money in my 401k and I was 23 years old and it was you know, what, 28-year time horizon, 30, anyway. I'm not doing the math right, but anyway, it was a much longer time horizon compared to that. So but it's fair. I mean, you have to plan on that. Like if you're going in thinking you're going to turn around or thinking you have liquidity when you don't, then that makes it a downside. But I don't know that I think of it as a downside.
Okay.
It's just enough factor
So,
to consider.
so like you're saying, longer time horizons in some situations is true. The underlying actual investment has a longer time horizon than a mutual fund, which is obviously liquid,
Yeah.
right? Immediately liquid. Like you said, if you wrap that in something else like an IRA or 401k, suddenly the liquidity, goes down. And really, I was going to interject and say, well, Rod, I don't know that that's totally fair, because technically you can still get to it. You just take a 10% penalty. That having said that, if you're like most people, your 401k money, unless it's an old 401k, usually you can't get to that money if you're still working at that place, right?
Mm-hmm.
So if I'm at an old 401k, if I have an old 401k, I roll it into an IRA, like I can go get that, take the 10% penalty.
Yeah.
It's still relatively liquid. If on the other hand, I roll that into my new 401k, all of a sudden that becomes illiquid until the point in time that my current plan tells me that I can use it, which is generally once you retire. Occasionally, we've seen situations where people can get to it for a handful of years before they're in retirement.
Yeah.
But that's, again, usually the exception rather than the rule. So anyway,
Yep.
I think that's true. But again, 10-year time frames is common when you get into like a real estate deal, or precious metals, or really a lot of the harder assets. You want to have a little bit longer time frames.
Yeah.
Okay, Rod, number 2, the potential for gates and fees. Okay, so here's the deal. This one, I didn't know what it meant by gates. I was like, okay, so to limit redemption and prevent a run on a fund, liquid alternative funds will often impose a gate. If more than 5% of the investors wait to exit the investments per quarter, this means that once a fund reaches the 5% threshold, investors will not be able to exit the investment. Okay.
Yeah.
So this is like a really specific example though, right? So I don't know that this one is ultra relevant, but the fee part might be. So the potential for this other stuff, is it real?
Yeah. I mean, and the answer is yes, right? Depending on what you're investing in. Okay, I'll give you an example. We were buying some precious metals, and you knew if you bought it today and you were thinking you were going to sell it tomorrow, you were going to have to sell for whatever, like 15% cut or 20% cut because you had to pay the seller, right? So, yeah, fees, sure.
Okay,
But
fees.
again, compare it to stocks or compare it to other things and, fees.
Okay, Rod, number 3, complex tax reporting. Unlike stocks and bonds, which are reported to the IRS via 1099, alternative assets are partnerships that require investors to file Schedule K-1 forms.
Mm-hmm.
More complex than 1099s, Rod. Is that a problem for you?
It is a downside, I would say. I talk to people regularly, and they're often unhappy about the fact that the K1s always come late. I shouldn't say always.
Yep.
Often come late. They're trying to file their extended return in October, and they're still trying to get their K1s. So that's
okay. What about lack of control? This is interesting, Rod, because oftentimes we go the other direction with this.
Mm-hmm.
Okay. Since alternative investments are limited partnerships, fund manager holds all the control to decide how long to invest and when to sell. What do you have to say about that?
I'd say that's a potential downside for sure.
Okay, but again, like the challenge I'm having with some of these is that they're like really specific to a
A handful
definitive
of-
asset
yeah.
or like a fund or something like that. But like that's not always true, right? Like obviously if I am doing a real estate deal on my own, there's not a fund manager even involved.
Yep.
Right. So anyway, probably depends on the situation.
Yep.
Okay. And then last one, and these are kind of funny because like they're all true, right? But again, the question is in comparison.
Yep.
So Rod, number 5 is potential for underperformance. All right.
I mean,
What do you think? Okay, this one's kind of lame because it's really talking about liquid alternatives. So it says, which
Okay.
again is ironic because up above it said that we have no liquidity, but now they're making a bunch of points about liquid. Okay, I don't want to go into any more of it. Here's why I brought it up. I just wanted to bring in both sides of the equation
mhm.
and look at these and say, okay, like we are constantly touting the value of moving into the alternative space as a
Yeah.
more effective way to build wealth, but are we being fair about it? Like, is it honest? Is it truthful? Is it authentic? And therefore, what? Or therefore, it feels relevant to talk about those things that are true. So, quick thoughts on this. Every one of those are true. Like all of those have some legitimacy to them, and yet the real question, from my perspective, has less to do with like I view these as more of like characteristics of certain types of investments.
Mhm.
Hard to say that they all fit inside of alternatives. It's too
Yeah.
broad. But the question I would ask is, does the potential or the upside and the opportunity and the additional benefits, right? Being able to use leverage, create cash flow,
Mhm.
being, using the investment optimizer to create the additional layer of profitability, like doing all these things, creating tax benefits,
Mhm.
depreciation that I can't get. So like, so yes, I'm going to have more complex tax reporting. The question is that more complex tax reporting worth the value that I'm getting, the tax benefits I'm getting that are requiring me to do that?
Right. Right. And the thing I would say is if you're looking for a place to invest your money that brings zero risk, it doesn't exist. It does not exist.
Well,
Holding it in cash
has no negatives, right? Everything has some negatives,
has some negatives and has some risk.
quote
Like
unquote negatives.
if you say, well, I'll just hang on to the cash and put it under my mattress, well, that's risk, right? That lost value in the last few years. And so anyway, that the idea that there are risks with everything is absolutely true. So we would say understand those. Like anytime you're going to look at any alternative class, be it real estate, whiskey, business, whatever.
You're speaking to the potential for underperformance right now.
And I would say even across the board, like even the previous points that they brought up, because understanding the liquidity of the thing I'm investing in is critical, right? The time horizon, the tax, like, okay, great, there are tax benefits that come with it. How do I take advantage of those?
Okay, Rod, but is complex tax reporting a risk? That's not a risk. Like
It's only a risk
it's
if
a pain in the butt, but it's not a risk.
it's only a risk to the extent that if it's not worth it to me and I give up the tax benefits because of the complexity, then it didn't end up being a benefit for me at all. Right.
Okay. I didn't really think of it in terms of risk, but I'm with you. Okay. Let's do one more and then we'll call it a day. Should we?
Yep.
Okay. Oh, I have to make sure I get to this one. We have to do two more.
Okay.
We have to do two more. Okay. Wall Street Journal, Rod. This is just kind of a quick one. So I'm going to describe this for people. Sotheby's, I don't know how to say that. Sotheby's sold Mark Rothko's untitled Yellow and Blue piece of art to an anonymous Asian collector for $46.5 million. And I'm just going to describe this piece of art to you. It is a rectangle, right? Just
Okay.
think rectangle the top half is yellow, like a goldish yellow, painted, and then the next like 90% of the next half is blue,
Okay.
and then there's not like a straight solid line. It's more just like looks like a painted, like they
Okay.
stopped painting, and then the very bottom is gold again.
Okay.
Like yellow gold. That's it. Rod, like I am a poor artist and I am pretty certain that I could pull this thing off.
Yeah.
And so what I'm suggesting here, Rod, is that maybe we should all go make millions by I don't know if it's investing in art or being the artist. I don't know, but like art, Rod. What do you think? This is I teased that there was going to be an art element here, and
Yes.
sure enough, there is. That is one painting for nearly $50 million. Oh, Rod, you know what? I went to Scotland once upon a time. This
Okay.
was years ago, and I was in a castle, like at this big estate, right?
Mm-hmm.
And it was we were just going in it to like tour it. We spent a handful of hours there, and when we got in there, they told us that there was $1 billion worth of art
Oh, wow.
in that one building.
Wow.
Isn't that crazy?
That is wild.
Okay, can I just tell you, I was way more impressed with the art that I was seeing there than the art I'm seeing here. But I just probably don't have quite the eye for art. I'm telling you this, I wouldn't pay 50 mil for that one, Rod. I'd be terrified that like a week later they'd be like, oh, actually that's worth like 50
Turns
bucks.
out.
I'm like, shoot, that's a okay. Anyway, I just thought it was kind of a funny, interesting, like
Yeah.
crazy thing.
I
So,
enjoy art, but yeah, I've never paid more than a few $100s for a piece of art. So
okay. Yeah, I have like, especially for like big, like for
Yeah.
a big piece of art, like I've spent a little bit of money on it, but anyway, that one is wild.
And it's usually the frame.
If you
is the more
know,
expensive part.
your art, then hey, it
Go
could be
for
a
it.
really good opportunity, right?
Yeah.
Why not? Okay. We don't even need to grade that one. We're moving on to our final one, Rod.
Okay.
This is great. Okay. 40-year-old works only 5 hours a week and makes $160,000 a month in passive income. And this is what he says. There's 3 complete lies about side hustles. Okay?
Okay.
Lie number 1. You have to work a lot of hours to make a great income.
Okay.
Lie number 2. You have to have a large team in order to make a large income.
Okay.
Lie number 3, your happiness will increase as your income increases. Okay, Rod, what's your take on the 40-year-old that works only 5 hours a week and makes $160,000 a month in passive income?
Yeah, I mean, lie number 1, it's true. That's a lie. I mean, if you're saying a lie in the sense that if you're throwing a blanket over and saying this applies for everybody, then correct. You don't have to spend a lot of hours to make a lot of money. There are people
You're
out
saying
there.
it is possible to work
Yeah.
a few hours and make significant money.
Yep, I would say
We
there are a lot
genuinely
of people
believe
out there
that. There's
who-
tons of people who do it.
Yep, we see it.
Okay, I totally agree. And
Yep.
I think it's important, though. I think it's an important thing for people to realize that it doesn't have to be that way. Because sometimes we just come, maybe it's like beliefs that we had in our youth or whatever, or like we're passing it beliefs from one generation to another that like work equals value in all situations. And I just think people need to understand that you don't have to do it that way. And there's no better time in the world to exist than today when it comes to finding opportunities to make money in kind of more unique ways. So anyway, I like that one. Lie number 1, I agree.
Can I throw just a little caveat on there?
No,
And that
no, you
is,
can't. You can't. You don't have to work hard to get there if that's what you're going to say, Rod. So don't even start.
Okay. In a lot of cases, it takes more work on the front end. So to be 40 and be doing that, well, who knows when he was 30 what he was doing, right? So
maybe. But Rod, I will say this. There is a belief deep in my soul that there is too much emphasis on work just for the just to work.
Yeah.
And now that's great. If you want to work and that's like creates your like like value, like helps you feel comfortable and confident with yourself. Like those are all great things, right? But there really is an idea that the two are like directly connected. And I just don't believe that at all. That's the epitome of my life is creating a lot of income without having to. I have the choice and I choose to, but without having to work that kind of
Yeah.
time. And so like living something similar to that life is kind of like a lot of people could do it if they just understood that concept and started to work on efficiency. It's a
Yeah.
boring word, but
Yeah.
efficiency, man, it's just so critical. Okay, sorry. Lie number 2, Rod, you need a large team to make the buco bucks. What do you think?
Not always true.
Not always true. Okay. I'm going to just say not true. You don't need it because you're right, it's not always true. And I would say you don't ever need a large team. I mean, maybe that's not true. I'm struggling with this, but I just agree with it totally. I don't think this kind of goes into the same um, thought processes and philosophy in that first, which is in the first point, which is there's these typical things that we have to grow a company a specific way. And in order it's kind of a lack of focus on efficiency and using technology and all these different elements. And just the idea that you just have to hire a lot of people. If you don't have a company that has 500 people in it, you're not going to make a couple $1,000,000 a year. Because guess what? You can make a couple $1,000,000 a year with a team of 2 or 3, or you could make a couple $1,000,000 as the CEO of a large company.
Yeah.
It's interesting. Okay, line number 3, Rod. Your happiness will increase as your income increases. This one is a little tricky for me. So here's the deal. Does having money just like suddenly make you like a more like you wake up in the morning and any issues and challenges that you had before are gone? No, 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 no. However, not having the stress and um, hangover that can come from like money stress is incredibly freeing, right? And so from that standpoint, I do think there's this element to creating an additional level of comfort and happiness. But the question I think then is how long does it last, right? Or maybe it's is there a point, and there's studies that we've seen about this,
Yep.
right? But
Yep.
is there a point in time where it's no longer increasing happiness? We're no longer just like, freeing ourselves of financial worry. Now, is it really doing what it did at the front end? But I will say, I absolutely believe getting to a place of feeling financial free will 100% increase a person's happiness. That's my take.
Yeah.
What's
And
your
I
take, Rod?
can agree with that. And that, and you basically said everything I was thinking. The whole kind of diminishing returns once you get past a certain point is proven.
Okay, Rod, let's wrap this thing up then. I'm giving this one a solid A because this is totally up my alley. This is like my life philosophy
Yeah.
in this article. So I don't remember this guy's name, but Graham Cochran, that's his name, I think. Graham, you're nailing it, my friend. I love it. You don't have to have a large team. If you want one and you want to go big, I say do it. You don't have to go work a ton of hours. If you want to and you love what you do, I say do it. And all of those things will increase your happiness at least somewhat. Now that I'm saying that, Rod, I only like 2 of the 3. So
Yeah.
I have to bump it down to an A-.
Okay.
That hurts. But I like the philosophy in general.
Sweet.
Grade it for us, Rod, and then we're taking off.
Yeah, I'll just go B. My
Ouch.
caveats.
Like,
So
that was like a little punch in the gut,
no,
Rod, but
no,
okay.
nope.
Okay.
This
Okay.
is no
B
surprise
is
to
good.
you or to me that we don't always align, but
Yeah, that's okay. That's okay. I'm just right. That's the difference. As long as we know at the end of the day
as
that
long
I'm
as we can
right,
agree on
Rod,
that.
then As long as we can agree on that, everything's totally. No, I'm just
Yep.
kidding.
All right.
I think your perspectives are totally valid, Rod. Okay. Thank you,
Thanks.
everybody, for listening to the Money Insights podcast, and we'll see you next week.
Thank you for listening to the Money Insights podcast. To learn more about the financial and business strategies discussed in this show, please visit moneyinsights.net. The views and opinions expressed on the Money Insights podcast are not intended to be individual financial, tax, or legal advice. Always consult with the appropriate advisor before making financial decisions. And if you're enjoying the show, please feel free to rate, subscribe, and leave a review wherever you listen to your podcasts. This will help others find the show and learn wealth-building strategies for themselves. Thanks again for tuning in, and we'll catch you in the next episode.